Well, it's certainly been the single most important issue that's dominated markets for the past month. Going into the month of May, market expectations were that rates would most likely be not going up until much later in the year. Looking back just to December last year, the Fed was talking about 4 rate rises for this year. Those hopes had been deferred a week. First quarter in the economy, difficult markets, difficult global conditions, expectations therefore deferred. Mid-month, the Fed released minutes of its April committee meeting where it determines interest rates, and they were actually on balance much more hawkish than people expected, and were pointing towards a rate rise probably in either June or July. Then literally within a couple of weeks at the end of the month, we had the payrolls numbers for May, which were extremely disappointing, the worst payrolls for about 4 years. So suddenly all bets are off again. In other words, the expectation for a rate rise in June or July has now gone to almost zero, and we're back to where we started at the beginning of the month. We might get a rate rise in September or by the year end. So it's been an extraordinary month in terms of expectations changing dramatically in mid-month and then again at the end of the month. And of course, markets have reacted to that all the way along. Expectation of an early rate rise strengthened the dollar, put pressure on emerging markets. Now that's been deferred, so we've seen the dollar backing off again. Risk assets have performed better, and in fact, equity markets are now almost back to where they were at their peak levels in mid-April. Well, there's been some improvement in the news flow in Europe. We've been saying for some time that things are beginning to get a little bit better in Europe. I think we've seen a continuation of that. The economic news has been a little bit better. I'm not talking about a dramatic uptick in growth, but it's beginning to get a little bit better. We've seen an increase in bank lending in Europe. We went through 3.5 years of contraction. Up until a few months ago, we've now had 9 consecutive months of expansion of bank lending. So arguably the ECB's asset purchase program is actually beginning to have an impact. Of course, bank lending will help growth down the track. And we've had some positive news on the Greek debt crisis. As far as its euro area partners are concerned, Greece has met its austerity target, so there's been a further disbursement of funds, and there's likely to be further debt relief over the next couple of years for Greece. So I think that's buying Greece more time. It's maybe kicking the can down the road, but it's at least helping them get through this difficult period. And I think the market sort of breathed a sigh of relief about that. So that's sort of gone off the radar screen as a major risk to Europe. So on the whole, I'd say Europe is just steadily getting a little bit better, and I think that's encouraging markets. So we've seen better performance from equity markets, and bond yields, which have got the support of the ECB doing this huge asset purchase program, have fallen again to near all-time lows in many cases, as well as corporate bonds, where the ECB is about to start its asset purchase program. The expectation is that we stay in the EU. So if we come out, I think most markets will have quite a wobble in the UK. The equity market likely to come down a fair bit, but it's sterling that's most vulnerable. The equity market is less vulnerable because most major companies earn a big part of their revenues outside the UK, so they're not going to be too disturbed. So maybe short-term sentiment hits equity markets and it bounces back. With sterling, I think people are going to be worried about the trade account. Are we going to be able to trade freely with the EU in future? We will for the next couple of years because we stay in the EU post June 23rd, whatever the outcome for a couple of years. But it's the trade account which I think people will be worried about, and it's sterling which will therefore take the heat. So I think sterling, if we were to leave, would come under pressure and stay that way for quite some time. Well, obviously the Brexit vote is extremely important parochially here in the UK, and I think has some importance globally. It's definitely very important for the EU because it could just trigger a whole sort of meltdown in the EU. Very unlikely, but if the UK comes out, will it be the only country to come out? What will Greece and Italy and Spain do about it? So that's certainly a big thing that I'll be focusing on, and also watching the data out of the States, not just in the coming month, but in the next few months. I think that's going to be pretty critical too. The third thing is watching what's going on in China. We've talked about this before, the whole rebalancing program that's going on in China away from investment and exports towards consumption and services. It's fraught with difficulties. We know there's too much debt. They're having to pay that back in China. All of that is creating headwinds for them. And wobbles in the currency are something else that the world will be watching out for. So I think they are the three big things that we're going to be focusing on in the next few weeks.